All right, welcome back to The Explainer. Today is April 29th, 2026, and let me tell you, looking at the data, the global crypto market is sitting right at the center of a massive tug of war. We are literally witnessing a collision of powerful macroeconomic events, sweeping regulatory shifts, and major geopolitical forces, all pulling digital assets in completely opposite directions at the exact same time. It's a lot to unpack, so let's get right into it. To really understand why today is absolutely crucial, we have to look at the immediate stakes. The market has been fiercely battling around this critical $74,000 to $75,000 support level for Bitcoin. This is our high-tension equilibrium line right now, mostly because the entire global market is just holding its breath for today's pivotal Federal Reserve decisions. Every trader, every institution, and every algorithm out there is just waiting to see which way the scale is going to tip. So here's our roadmap for today. We'll start with the macro catalyst, then look at the European compliance squeeze, move into global safeguards and crackdowns, check out how we're bridging TradFi and on-chain, and finally wrap up with this high-tension market equilibrium. All right, jumping into section 1, the macro catalyst, focusing on FOMC rates and the Hormuz rally. We are currently seeing what everyone in the market is calling the Hormuz rally. Following a ceasefire agreement between Israel and Lebanon, the critical Strait of Hormuz shipping route has officially reopened. This geopolitical de-escalation almost instantly triggered a massive risk-on mood across all global markets. And what happened next? Well, a massive cascade of short liquidations just hit the crypto market, accelerating the price action and surging Bitcoin up past that $77,000 mark. Suddenly, you've got bulls targeting much higher numbers. It's really a textbook example of how quickly geopolitical relief can ignite market volatility. Okay, let's dive into this. As the Federal Reserve wraps up its two-day meeting today, Kraken research mapped out two major potential paths. They're calling these the Warsh scenarios. Scenario 1, if the Fed delivers a 50 basis point rate cut, it acts as a massive risk-on trigger. We'd likely see a huge influx of cheap money liquidity that could vault Bitcoin toward an $85,000 late April target. But wait, look at the other scenario. If we get a rate hold, which, Governor Williams has hinted at, it kind of cements what traders are calling the Fed's ceiling. In that scenario, those recent 32,000 Bitcoin dumped by miners could completely overwhelm the current demand, triggering a brutal retest of that $74,000 support level. The stakes literally could not be clearer today. Moving on to section 2, the European compliance squeeze, specifically looking at the UK FCA and the EU's MiCA framework. So this timeline lays out exactly what is happening in the United Kingdom today. The UK Financial Conduct Authority, the FCA, has officially opened its crypto consultation window right now, April 29th. And this isn't just talk, right? It establishes a firm, actionable regulatory roadmap for firms operating in the British market. By mid-2026, we're going to see comprehensive rule reviews and firm assessments, all leading up to a hard regulatory deadline in October 2027. What you really need to take away from this is that the London Crypto Hub is finally getting that much-needed legal clarity. It's basically telling companies, comply or pack your bags. Now, what's really interesting about this slide is how the European Union is executing its own squeeze under the MiCA framework. Crypto projects can no longer rely on informal PDFs or Gitbooks for their white papers. Issuers must now adhere to strict, formal disclosure standards to even be legally recognized in the EU. This is a very deliberate crackdown designed specifically to eliminate low-quality or completely fraudulent offerings. The days of launching a multi-million-dollar token on the back of a loosely written PDF, those are officially over in Europe. Let's shift gears to section 3, global safeguards and crackdowns, checking in on Asia and South America. Look at the approach South Korea is taking right now. The Bank of Korea is currently pushing for mandatory crypto circuit breakers across all South Korean exchanges. Seeking to prevent absolute market meltdowns during periods of extreme volatility, these tools would automatically pause trading during rapid price drops. So the crucial point here is that we are actually seeing crypto infrastructure actively mirroring the traditional protections you'd find on, say, the New York Stock Exchange. They are actively trying to tame the Wild West of crypto volatility. And over in South America, law enforcement is making some massive waves. $320 million. That is the size of the crypto laundering ring that was just busted by Brazilian police. In a huge blow to organized crime, several high-profile singers linked to this network were actually arrested. This staggering number highlights a very vital reality for the market today. Global law enforcement is becoming incredibly sophisticated at tracking large-scale illicit on-chain flows. The blockchain's transparency is, quite literally, being weaponized against bad actors. All right, Section 4, Bridging TradFi and On-Chain, focusing on institutional integration. These 3 steps outline a truly massive strategic move by Ondo Finance. They have formally requested a no-action letter from the US SEC. Now, why does this matter for us? Well, if granted, it allows them to integrate blockchain technology directly into traditional securities infrastructure without the fear of immediate enforcement action. This would pave the way for the seamless tokenization of regulated real-world securities right onto public ledgers. So, despite all the regulatory squeezing we just talked about, institutional players are still actively finding legal pathways to bring Wall Street on chain. And finally, Section 5, High-Tension Market Equilibrium. Let's get to the bottom line. And this brilliantly illustrates exactly what we are looking at right now, the full push and pull of the market. On one hand, we have the macro push, the Fed rates and the Hormuz rally creating all this immediate extreme volatility. Then you've got the compliance pull, the UK FCA and EU MiCA squeezing those smaller, non-compliant projects right out of the market. And finally, the institutional shift, TradFi integration that actually takes the liquidity exiting those smaller projects and consolidates it into institutional-grade, highly regulated blue chips, like Bitcoin and Ethereum. It's honestly a perfect storm of opposing forces. Which really leaves us with the ultimate question for today's explainer. With absolutely everything hanging in the balance, will the risk on Hormuz rally continue to push prices higher, or is today's FOMC decision going to trigger a brutal period of macro consolidation? Keep a very close eye on that $74,000 support level and watch how these regulatory pieces continue to fall into place over the coming days. Thank you so much for joining me today. Keep learning, stay focused, and I'll see you in the next explainer.